All right, welcome to your market briefing for November 5th. Now, on the surface, the US markets had a powerful rebound today. But you know what? Don't let those green numbers fool you. There's a huge shift happening right under the hood, a real changing of the guard that could redefine the market leaders for the next few months. Let's get right into it.
Okay, so look, a rally after a big sell-off is always welcome news, right? But the real story today isn't just the bounce itself. It's where the money is actually flowing. We're seeing capital rotate out of the market's biggest darlings and into completely different sectors. That is the number one thing you need to be watching.
And the recovery was pretty strong across the board. All three major indexes finished solidly in the green. You had the Dow up almost 0.5%, the S&P adding about 0.37%, and the tech-heavy NASDAQ actually led the pack, popping 0.65%. For all three, this was their best day in over a week, wiping out a huge chunk of yesterday's losses.
So, what was the fuel for this rally? Well, it wasn't just people buying the dip. There were two key developments on the macro level that really lit a fire under the market.
First up, let's talk about the labor market. The October ADP employment report came in hotter than expected. Private employers added 42,000 jobs, which is way ahead of the 30,000 that was forecasted. Bottom line, it's a sign that the economic engine is still humming along, and that's always a positive for investors.
And it wasn't just jobs either. We also saw some serious strength in the biggest part of the U.S. economy, services. The ISM Services Index jumped up to 52.4. Now remember, anything over 50 means things are expanding. And this number didn't just beat expectations, it marks the fastest pace of growth we've seen in 8 months.
Beyond all the economic data, a pretty big tailwind came out of Washington. You see, Wall Street was glued to the Supreme Court, where the justices seemed pretty skeptical about the legality of some of the Trump-era tariffs. The market is basically betting that a ruling could limit those powers, which would be a huge sigh of relief for retail importers and consumer goods companies. And that optimism was a huge driver of confidence today.
Okay, but here's where the plot really thickens. This wasn't one of those rallies where a rising tide lifts all boats. Nope. Instead, what we saw was a clear, significant rotation in market leadership, especially away from one of this year's absolute hottest trades.
You can see that rotation playing out right here on the screen. Money was getting pulled from those high-growth areas like communication services and tech, both of which actually ended the day down. So where did that money go? It flooded into cyclical sectors, the ones tied more to the real economy. Consumer discretionary was the day's top performer, with materials and industrials right behind.
And believe me, market analysts were all over this. They noted a real hesitancy toward those high-flying tech names. So the big takeaway here is that this wasn't some broad risk-on free-for-all. It was a very calculated pivot. Investors were taking profits from the AI stocks that have been on fire for months and moving that cash into more value-oriented, cyclical plays.
Okay, so let's drill down to the individual stock level, because this is where that rotation story just becomes crystal clear.
On the winning side, wow, what a huge day for chipmakers. Seagate and Micron just surged, hitting all-time highs on signs of really strong demand. But we also saw strength in more traditional sectors, right? The healthcare powerhouse Amgen led the Dow gainers, and travel stocks like Southwest Airlines jumped over 6.5%. That signals some renewed confidence in the consumer. But now, look at the other side of the coin. The whole AI theme took a direct hit. Microcomputer, one of this year's biggest AI darlings, plunged over 11% on some heavy profit-taking. And even the undisputed king, Nvidia, couldn't escape the pressure, falling almost 2%. This is the other half of that rotation story in real time.
So the billion-dollar question is, what does this all mean for the market's direction? Is this rotation a sign of underlying strength, or is it a warning that the high-growth leadership we've seen all year is finally starting to crack?
Now, if you're looking at the charts, the bulls have a reason to feel good. Both the NASDAQ and the Dow bounced perfectly off their 20-day moving averages. For traders, this is a key short-term support level. Think of it like a line in the sand where buyers have consistently stepped up to the plate. The fact that this level held is a very positive sign. And you could see this restored confidence in the market's fear gauge. The CBOE Volatility Index, or the VEX, dropped more than 7.5%. A falling VIX basically means traders are pricing in less choppiness ahead, and it's a signal that that immediate, near-term fear has backed off. And that brings us right back to the big question. While that bounce off a key technical level is really encouraging, the rotation happening underneath the surface suggests a more cautious mood.
So is this just a temporary bounce before another leg down, or is this the start of a sustainable rally just with entirely new stocks in the driver's seat? That is the puzzle the market is trying to solve right now.
And that's your market briefing for today. It was a really fascinating day of cross currents, and all eyes are going to be on whether this rotation has any staying power. As always, please remember that investing involves risk, so be sure to do your own research. We'll see you next time.